Picture this. Someone close to you, a parent, a spouse, maybe even a sibling, passes away. It's already the hardest thing you've ever dealt with. You're grieving, you're exhausted, you're running on autopilot, just trying to get through the week. And then a letter shows up in the mail. It's from a debt collection agency. They're telling you that you now owe $23,000 on a credit card account. Your name isn't even on the account, but somehow, some way, they're coming for you. And here's the thing, this actually happens all the time. And most people have absolutely no idea what's legal, what's not, and what they're actually responsible for. Because nobody ever teaches you this stuff. Not in school, not at work, not from your parents. So today, we're going to fix that. We're going to walk through exactly what happens to your debt when you die, who actually has to pay it, and what you need to do right now before it becomes your family's problem.
Look, let me start with a number that should genuinely make you uncomfortable. According to a study by Experian, the average American dies with over $61,554 in debt. That's credit cards, car loans, medical bills, personal loans, all of it sitting there when the final chapter closes. And yet, I'll ask you this. When was the last time someone sat you down and said, hey, here's what happens to all that debt when you're gone? Never, right? Because we don't talk about death in this culture, and we definitely don't talk about money. So combining the two? Forget about it. But ignoring it doesn't make it disappear. It just means your family gets blindsided at the worst possible moment. So here's how this actually works, and I'm going to break it down in a way that finally makes sense. When you die, legally speaking, all of your assets and all of your debts get pooled together into what's called your estate. Think of it like a big financial bucket. Everything you owned goes in. Your house, your car, your savings, your investments, even that dusty guitar in the corner. And so does everything you owed. Then, before a single dollar goes to your family, that bucket has to be settled. Your creditors, the banks, the credit card companies, the medical providers, they have the legal right to file claims against your estate. They get paid first. Your loved ones get what's left. It's not heartless. It's just the law. You can't give away money you borrowed and never paid back. That's not how contracts work. Now, here's where it gets really important, and this is the part most people get wrong. In the vast majority of cases, your family does not inherit your debt. Let me say that again. Your kids, your parents, your friends, they are not on the hook for money you owed just because you're gone. The debt dies with the estate, not the people who loved you. But, and this is a big but, there are some major exceptions. And if you fall into one of these categories, it changes everything.
Exception number 1, joint account holders. If you and your spouse both signed for that credit card, both names are on the loan, you are both equally responsible for that debt, period. When one person dies, the other person still owes every single penny. This is completely different from being an authorized user, which is where someone can use your card but didn't sign the contract. Authorized users typically walk away free. Joint account holders do not. Exception number 2, community property states. If you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, your marriage legally makes most of your debt a shared debt, even if only one of you signed for it. Spouses in these states can be on the hook for debts they didn't even know about, which is a lot. Exception number 3, co-signers. If someone co-signed a loan for you, a parent who helped you get your first car, a friend who vouched for your apartment, they are fully liable for that debt the moment you're gone. Fully. As in, the lender can come after them for the entire remaining balance. That's the risk of co-signing that nobody explains clearly enough. And exception number 4, and this one sneaks up on people, medical debt in states where spouses share financial responsibility. Hospital bills after a long illness can be astronomical. In some states, a surviving spouse can be held liable for those costs. It depends on where you live and what contracts were signed during treatment. Now, here's where I need to pause and warn you about something.
Because even when your family is not legally responsible for your debt, there are debt collectors who are going to try to convince them otherwise. This is real. The Consumer Financial Protection Bureau has documented thousands of cases where collectors called grieving family members, used manipulative and even illegal tactics, and pressured people into voluntarily paying debts they had absolutely no legal obligation to pay. They prey on grief. They count on people not knowing their rights. Here's what you need to know. Debt collectors are legally allowed to contact family members to locate the executor of the estate, but they are not allowed to misrepresent what relatives actually owe. Under the Fair Debt Collection Practices Act, if someone calls you about a deceased family member's debt and you're not a cosigner, not a joint account holder, not in a community property state, you can tell them you are not responsible and request they stop contacting you. Write that down. You are not responsible. Stop contacting me. That's your power. Okay, so let's go through the most common debt types because they don't all behave the same way, and this is where people get really confused. Credit card debt. If it's in your name only, it goes through the estate. If the estate has no money, the debt typically gets written off. Your family doesn't pay it out of pocket unless they're a joint account holder. Mortgage. This one's different. The house is collateral. If no one takes over the mortgage payments, the lender can foreclose. But a spouse or heir who wants to keep the home can often assume the mortgage. The Garn-St. Germain Act actually protects surviving family members who inherit a home. Lenders generally can't call the entire loan due just because the original borrower died, as long as someone continues making payments. Student loans. Federal student loans are completely discharged upon death. Gone. No estate payment required. Private student loans are messier. Some lenders discharge them, others may pursue the estate. Some may even go after a cosigner, which is horrifying, but it happens. If your parents co-signed your private student loans, this is something you need to sort out. Car loans. The car is collateral. If someone in the family wants to keep the car, they can usually take over the payments. If not, the lender repossesses the car and settles the debt with whatever the car is worth. If the car is worth less than the loan, the difference becomes an estate debt. Medical debt goes through the estate like credit card debt. If the estate is empty, in most states, children are not on the hook for a parent's medical bills. However, and I say this with a heavy sigh, some states have what are called filial responsibility laws. These laws can, in certain situations, require adult children to contribute to a parent's unpaid care costs. Pennsylvania has actually enforced this. It's rare, but it's real.
Let me give you a metaphor that I think ties this all together, because I know this is a lot of information, and I don't want it to blur together. Imagine your financial life is a restaurant. You're the head chef. You've been cooking up assets, savings, property, investments, and cooking up debts, loans, credit cards, bills. When you die, the restaurant doesn't just close and everyone goes home happy. What actually happens is the creditors are like suppliers who are owed money. Before the kitchen can be handed over to your family, every supplier has to be paid from the cash register. First come, first served. Secured creditors, like mortgage and auto lenders, they're at the front of the line because they have collateral backing them up. Then come unsecured creditors, like credit cards. Then, finally, what's left goes to your heirs. If the cash register is empty before everyone gets paid, most creditors are out of luck. But your family doesn't have to reach into their own pockets to make up the difference, unless they were already named as co-owners of the restaurant. That's the key distinction. All right, so now that you actually understand how this works, and believe me, most people never get this far, let's talk about what you should actually do about it. Because information without action is just trivia. Step 1. Know what you owe and who owns it. Sit down today and make a list. What debts do you have? Are any of them joint accounts? Are you a cosigner on anyone else's debt? Do you live in a community property state? These answers matter enormously. Most people have no idea what's in their own financial picture. Step 2. Get life insurance. I know, it's boring, it feels morbid, but a term life insurance policy can be extraordinarily cheap when you're young and healthy. We're talking sometimes $20, $30 a month for significant coverage. The point is simple. If you die with $50,000 in debt and your spouse is a joint account holder, that policy pays it off, so your family isn't buried alongside you financially.
Step 3. Write a will. Actually do it. Only about 33% of Americans have a will, according to caring.com. Without one, your state decides what happens to your assets, and it may not match your wishes at all. There are legitimate online services like Trust and Will or LegalZoom where you can get a basic will done for under $200. There's no excuse anymore. Step 4. Name beneficiaries on everything. Your 401k, your IRA, your life insurance policy. Assets with named beneficiaries pass directly to those people and bypass the estate entirely. That means creditors can't touch them. This is one of the most powerful and underused tools in personal finance. If you have a retirement account right now and you've never updated your beneficiary, stop this video and go do that before you forget. Step 5. Have the conversation. Tell the people who might be affected, your spouse, your kids, your parents, where your accounts are, what you owe, and what your wishes are. Put it in a document. It doesn't have to be dramatic. It's just responsible.
Here's the uncomfortable truth. We spend a ton of energy building wealth, working harder, investing smarter, cutting expenses, and almost zero energy thinking about what happens to all of it when we're gone. And that gap? That's where families get destroyed. Not by grief alone, but by financial chaos that was totally preventable. You now know more about this topic than the vast majority of adults walking around today. You know how debt flows through an estate. You know who's actually liable and who's not. You know the tactics collectors use. And you know the 5 steps to protect the people you love. The only question left is whether you actually do something with it. And I genuinely believe you will, because you wouldn't have watched this far if you didn't care. If this helped you, share it with someone who needs to hear it. Drop a comment below telling me which part surprised you the most. I read every single one. And if you want to go deeper on building a financial system that actually protects your family, subscribe, because that's exactly what we do here.